Welcome to Author's Note. Property is one of the asset classes most closely associated with precipitating the financial crisis. Banks across Europe and America are still awash with the legacy debt of not having properly understood the financing of the last real estate boom. You might therefore assume that property would be far away from most people's minds in this low-risk environment. But in reality, many investors are turning to it as a haven asset class. With me to discuss how one asset class can be both on the market for cautious investors and reckless enthusiasts is Bill Hughes, Managing Director of Legal & General Property. Bill, let's look at this first chart that's showing us city property yields versus UK government gilts and the FTSE 100 investment grade bonds. Now, just explain to me what's happening here and why it is that city property yields are so attractive compared to other low risk investments.
That's in part because the expectation in a low inflationary economy is that gilts and similar sorts of investments are there to provide some sort of a secure income return. And I think property, in the eyes of many, is actually seen as carrying risk, principally because of illiquidity. But in fact, for those that don't require liquidity investment, the yield pickup, you can see here, very much broadening there. The red line being higher makes property relatively appealing.
Just take me through what kind of buildings we might be describing here.
Yeah, a lot of the market there is for landmark trophy buildings, the sort of thing that overseas investors would like to have on the front of a brochure. Good tenants, relatively modern. That's what people generally perceive when they talk about that market. But of course, within that market, there are also a lot more appealing assets with high yields, but where you have to have active management to deliver returns.
Now, if we move on to the next chart, we're going to see some of these more appealing assets with high yields. This is a split between what's sort of prime in the city that we just talked about, and then the UK secondary market, where obviously we see this huge divergence in the last few years. Now, explain to me why this is happening and perhaps some of the opportunities you might find on the blue line.
What this hides, of course, is the difference between what I would call secondary assets with potential, where you can manage and deliver returns, and secondary assets that are becoming obsolete and going to underperform. So within this line that is moving out and therefore on average values are falling, there is enormous opportunity for a stock selector to pick the right assets and benefit from a very attractive in yield, but also then manage to deliver capital value growth from there on.
And how would you as an investor look at these assets? How would you assess whether something was good, how it compared to, say, a bond or another low-risk investment?
Yeah, I mean, some of the assets in this group here really, in essence, are going to behave like a corporate bond, to the extent that the person paying the rent, the tenant, may well be the same corporate as you can acquire through a corporate bond. And in essence, the skill set is in assessing the credit, assessing the stability, the certainty of that income over a long period of time. And in property, then you can get the advantage of a high yield to compensate you for the illiquidity, but also some of the management activity that's going on.
Now, let's just lastly look at some of the risks involved in buying property, where obviously this is where it differs from a bond. So explain to me here what's happening. We're seeing the price of property in the prime central London market going up and down hugely over the last 30 years here. So explain how you would mitigate this risk as a buyer coming into this market.
Yeah, it is worth remembering that all property markets are relatively cyclical, and central London is the most cyclical, so there's risks associated. And I think the issues to get one's head around here are certainly playing the timing game is important. To get into the market at the right time and to get out of the market at the right time is a very important thing to get right, because over the long run you can see that there's not actually a lot happening, but there's some implicit volatility, some volatility tied into the investment choice. The other thing to get right here is clearly to find the right assets in that market, because it is possible to insulate from that sort of volatility, because like everything else, this is just an average for a market. So there are better opportunities within that market, but I think strategic timing is critical here.
Bill, thank you very much.
Thanks, Ed.
So for those willing to take the time to understand the risks properly, there are still huge opportunities to be had in the real estate world.